summer, in stock market terms at least, we have an action-packed week coming up. On the macroeconomic front, we've got three key highlights. On Tuesday the 13th, UK inflation figures. All eyes will be on whether the Consumer Price Index, or CPI, reading will rise further from the 2.7% increase seen in April. On Wednesday the 14th, we've got the latest US interest rate decision from the Federal Reserve. Despite some wobbly jobs and car sales figures, the market still expects a 0.25% increase in the Fed funds target rate, the second hike of this year and fourth of this upcycle. And then, Thursday the 15th, the latest interest rate decision from the Bank of England. No changes expected to interest rates, 0.25%, or quantitative easing at £445 billion. Watch though for the voting patterns to see if there's been a shift in sentiment. In May, the vote was 7-1 to leave rates unchanged and unanimous to leave QE unchanged. Now, company-wise, we've got a smattering of FTSE 100 firms due to make statements and a good number of FTSE 250 members releasing numbers. They include full-year results from equipment hire giant Ashtead and a first-half trading statement from theme park operator Merlin Entertainment on Tuesday the 13th, trading updates from house builder Bellway and retailer WH Smith on the 14th, and trading statements from power utility Drax and soaps to beauty and baby care group PZ Cussons on Thursday the 15th. But for me, the most likely source of a big fuss is the first quarter trading statement due for release from supermarket giant Tesco alongside its annual general meeting on Friday the 16th of June. As we can see from this chart, the shares have scraped out a 15% gain, or there or thereabouts, over the past 12 months, although the FTSE 100 is up by a fifth over the same period. Moreover, Tesco shares are actually down by nearly 16% from their December peak. That fresh slide may be due to three factors in particular. First, some scepticism over the planned £3.7 billion merger with food wholesaler and FTSE 250 member Booker, a deal which large institutional shareholders in particular have publicly questioned. Second, how a rise in the oil price and some weakness in the pound have combined to drive UK inflation up to that 2.7% figure on the CPI, a 3.5-year high and a level that may start to crimp consumer spending power, especially as wage growth is lagging at just 2.2%. And the third possible negative, that's the fierce competition which Tesco faces every single day. Not just from the other Big Four members, Sainsbury's, Morrisons and Asda, but the upstart discounters Aldi and Lidl. This chart here features data from consultants Kantar World Panel. It shows Tesco's market share, and note how it's dropped from 28.3% to 27.8% over the past 12 months. Compare that with the next two lines, which show Aldi and Lidl's relentless market share gains from 10.4% to 12% between them over the same period. The discounters are keeping the pressure on prices as they take market share, and while the Kantar World Panel numbers for May did show Tesco clawing back some market share and increasing sales by 1% year on year, Aldi and Lidl grew their sales by 19.2% between them. This all makes the Tesco first quarter trading statement particularly timely. The company will release no profit figures, just like-for-like sales numbers, but that should still be informative. Remember that UK sales rose 0.9% on a like-for-like basis, excluding VAT and fuel, last year, the first annual increase since 2010. However, we can see on this next chart that momentum tailed off a bit at the end of the year, so analysts will be looking to see how UK sales growth compares to both the full year number and the 0.7% growth rate from the fourth quarter. Also note from the graphic how both Europe, down 0.8% like-for-like in Q4, and Asia, up just 0.5% year on year on the same basis, both did relatively poorly as last year ended too, so make sure you look at those figures as well. At least the Kantar World Panel numbers offer room for encouragement, as Chief Executive Dave Lewis does need a sustained improvement in the top line if Tesco is to progress toward the 3.5% to 4% operating margin target laid down for 2019-20. That's underpinned by £1.5 billion in further cost reductions and average capital investment a year of £1.4 billion, although the Booker deal is likely to affect those numbers over time, assuming it goes ahead of course. Watch out for any updates on any of those numbers. Thank you for watching, and I look forward to seeing you next.